Focus on being productive instead of being busy. Someday is a disease that will take your dreams to the grave with you. Tim Ferriss. Ooh, heavy one to begin with. Guys, we are ladies, guys, gentlemen, whatever out there in the land of podcasts. We are against the grain, as you guys know. We are joined by Josh Bennett today. We're going to talk to how to set yourself up for success by building the right financial habits now. So we are probably going to get into Robo's college days because this is Robo's college buddy here. So it's probably going to be embarrassing for this asshole. But nonetheless, we're going to find out how our last 7 days have been. I'm going to begin it with Scoob, who's looking a little lush over there. This weekend you spent your time at Home Goods and were shopping and so forth. Did you find any comfy pillows that you found yourself like really enjoying?
You're funny. We were at Home Goods.
I fucking knew it.
I found a thing to put into the bed where you're supposedly supposed to sit, and I'll probably never use it. We didn't buy a bunch of pictures or anything yet. We're gonna wait till all the furniture's in and then do that. But yeah, man, it's just been furniture shopping. The blind guy's over there today at the new house measuring. So all that.
When do you move?
Shit. Huh?
When do you move?
I got to be out of here October 3rd, but we're going to try to be done by September 30th. We close on the new place September 20th.
Okay, cool.
So we got to go out of town like the 21st for Kayla show, pro show in San Antonio. So we just figured we'll just do it the 30th, but we take ownership the 20th.
Nice. Well, congratulations.
But, yeah. Other than that, Scooby Preps, Scooby Health is doing great. Adding new clients, coaches are doing good. I'm getting more and more signups for the Introduction to Functional Nutrition course October 16th. There are some spots, but they are filling. If you're interested, email me and we can show you how to get registered. Other than that, man, kind of business as usual. Don't have much to report otherwise.
Yeah, I'm in the same boat over here. Keegan met with his coach, Cameron Cheek. He forgoes all his chips now for fruit, apparently. So that's a pleasant change. It's more expensive at the grocery store, but it is what it is. Business has been good. I'm kind of doing some revamping stuff because I had some staff turnover that was necessary in order for me to go where I wanted to go. And I learned a lot of things about what I really wanted in business versus what I really thought I wanted in business. And they're like two separate things I've figured out. I'm like you, man. I'm excited to do your functional class. I'm in there with you, me and a couple of my coaches to help us get a little freshened up on some of that stuff. It'll be nice for me because I've spent the last 2 years in a hole writing a book. And then I got the preview of the Steven Pressfield interview where he interviewed me out in Cali. We had a great conversation. So that will be going up on YouTube here soon, and along with the website for my pre-order of my book. I've got to send you guys what that cover looks like, and we're going to swap a photo or two out, get your guys' opinion, and then hopefully from there I meet the publisher who's actually here in Nashville next week or the week after. I think it's one of those 2 days. And then I'm looking at, this hasn't been shared much, but I'm looking at expanding Iron House, and I'm going to go look at a place that's up the street from us that has 20,000 square feet. So I'll go from 8,000 square feet to 20,000 square feet, and I think it'll be a really good move for what we need to do, because Robo's in there and we're busting at the seams with equipment and people at times, which is a good problem to have considering I charge the most for any gym around me. So all good things, just, a lot of decisions I have to make. And so I've been lucky to have some free time to think lately, which is always beautiful without drugs. I've been drug free. just saying. Robo, how has your last week been? Anything exciting? Parents were in town. That must have been great. Honky tonking with them here in the Ville.
Yeah, you die a little bit every time you go onto Broadway. So I died a lot this weekend, but that's okay. It was good to see them. And man, they can put down a few drinks. It's hard to keep up. I barely drink anymore. I just get my butt kicked everywhere we go. But no, I don't know if I've ever even said what I do on this show, but I sell businesses and it's insanely busy right now, despite the higher interest rates. So it's good.
Why do you think
it's
that
a good
is?
time to make money. You got the boomer generation retiring. So a lot of my sellers are retirees. It doesn't really matter anymore that the interest rates are up. They're not going to try and time another cycle. They're just ready to be done. And enough people are interested in controlling their own destiny that they're jumping in and saying, yeah, I'm going to buy it and I'm done working in corporate America. So have a ton of buyers, ton of sellers. It's great right now, but very busy.
What is the one thing, if I was to sell my business, that I should have in place first before I contact a guy like you or a lady like you?
Yeah, you either need to have your financials in order, so have a P&L, and it's got to roughly match your taxes, or you need to hire an accountant to do that. If you don't know your own financials, how do you expect someone else to understand them and be willing to risk, hundreds of thousands, if not millions of dollars on it?
Yeah, no, I agree. The amount of people who show up probably without that information is enough to drive you mad and gray in your hair, I bet.
More than half don't understand whether or not they're making money, and if so, how much.
Wow, that's crazy. Well, Josh, you're joining us today. You're the founder and managing partner of Vincere Wealth Management. You work with clients to simplify planning, execute their investment strategies to reach their goals, among probably happiness of death when they no longer have to pay taxes on anything because they're not here. How's your last week been?
It's been actually pretty mild and busy. So we actually own a tax practice and accounting practice too, and it's getting 2 weeks to the corporate deadline for extensions, so it's starting to get pretty busy pretty quickly, unfortunately. But aside from that, I have two little ones at home, so both under 2.5. So
I do not envy you at all.
Yeah, my weekends are pretty lame usually. They're just hanging out with little ones and doing whatever they yell at me to do.
Have you gotten snipped yet?
Not yet.
Jason and I did it. The best decisions of our lives. Like it was amazing. Peas on your nuts for 3 days. And then after that, it's like back to the charge, my friend. And you're like, boom, no child support every time you do it. You don't have to worry.
Josh is married. He doesn't get laid.
Exactly.
That's how it works, right?
Built-in birth control.
Yeah.
not one of those like wifely duty things either. You're like, no, just no, and like don't have to worry about it.
Exactly. It's not an issue.
Well, let's get a little bit in your background. So you know Robo from your wild college days. So kind of take me down the road in the audience of what got you in to doing what you're doing with financial wealth management, because I'm just a dumbass when it comes to finances. So I'm excited to do this podcast because I didn't even start a 401k until I was 37 because I spent all my money building my assets in my gym and made dumb decisions along the way. And that's part of it.
Yeah, that definitely is part of it. But yeah, kind of what we find all the time is that people end up starting way, way, way too late when they should be starting much earlier. But yeah, sort of frankly fell upon financial planning as opposed to any clear path to get there. Like I'd originally planned on being an attorney or something like that, then shadowed an attorney my senior year of college and quickly realized I did not want that lifestyle whatsoever. Like it was horrible. And then so through happenstance, a mentor of mine happened to work at Charles Schwab and got me a gig there. And that's actually, so Rob and I actually lived next to each other in college, which is how we originally knew each other, but then happened to be basically, across the way desks back in the day, like, at Schwab on the call center phone lines.
I think we lived next to each other again there too.
Yeah, I think, like within probably 10 feet of each other. So something like that.
Was it like boiler room with you guys? Were you guys like lying and shit on the phones? Like, fuck yeah, close another like 200K.
Every day.
Every day?
Yeah.
I love that.
Absolutely. Although I had the night shift for a while there and definitely got some interesting phone calls. A lot of drunk people at 2 a.m. yelling about their debit card. That's exciting. But
I did the same thing. I worked for Fidelity, and so
nice.
I did the same shit. I lasted a year.
That's I think. How long did you last on the phones, Robo? 2?
A year and a half.
Oh shit! Robo lasted that long? I'd give him 2 months in the current state of Robo.
So, yeah, I made it a year, and then I was like, I gotta get the fuck out of here.
Yep. What made you guys get into that? Is that where you guys like have to pay your dues and shit?
Yeah, exactly.
Pretty much. I got my Series 7 and 63 through them free, so I could have definitely bolted and went, more long, a financial planner type role, but I went to law school, so.
Yeah. No. The paying you understand why I ran. I mean, those companies pay for you to get your licensing. They're pretty good training grounds. Yep. So half the financial industry was trained at Fidelity, Schwab, TD Ameritrade, maybe some at E-Trade. It's a small circle.
Yeah, exactly. It's basically just especially if you didn't like go to college for finance, like it's it's kind of the, hey, this is your foot in the industry without having to go back and get a master's or any of that stuff. So you get your 7, your 63, which for those people that don't know, that's basically your license to be able to buy and sell stocks for people. And so, yeah, so started there, like to get my foot in the door. And then that's, where I really realized like I actually liked helping people with financial planning as opposed to just buying and selling stocks. And so then sort of went more to the branch life at Schwab, did that for like 5 or 6 years, and then sort of saw a little bit too much of how the sausage is made in corporate finance, just with like incentives, and that's where I ended up going independent, and so I could really actually start helping people and do right by them, kind of regardless of net worth, whether you had $50 million or $100,000. So that's kind of how I got into it, but it was definitely by no intentional planning, but haven't looked back since.
How hard is it to start something like that you did when you strike out on your own? Because I know in the personal training field, there's nothing at all. There's no barrier to entry. I'd be curious to see what it would be for your barrier to entry and like how you actually get something like that off the ground to make it worth your time to even do.
It's a pretty high barrier of entry, especially like from an education standpoint. Well, licenses and education. So, I mean, you have to have all your licenses, which the licenses to actually open an independent, like RIA, as they're called, like an independent financial advice business. They're not that terribly hard to get, but the ones that like the credentials, like the CFP and stuff that, make clients want to work with you, those are much harder to get. And you have to get registered with, like, if you're starting out, FINRA, which is like the regulating body for, an individual state or smaller companies. It takes like 2 or 3 months just to get registered. So like, for example, I had to leave my job, and then couldn't even try to sign a client for 3 months. And then, it was probably, the first year or two, I maybe signed a couple clients, because you're basically convincing people to trust you with their money when, you have no credibility established other than like your past. Right. Yeah. But then once you get that sort of first few clients, that's when the, referrals start happening. And then it becomes, you kind of hit that threshold where it just becomes a really actual sustainable business. But yeah, I mean, in my head, I was like, oh, this will take me like a year. When in actuality, it was like 3 years before it like really started bringing in anything.
That's how it is in business. You think it's
exactly
forever.
Yeah, never is. The credibility part of being a business owner is huge. Like that, you can't say too much about that. Where it's like you have to establish that. Yep. Like you were saying about your gym, like there's a reason people pay the higher price to come to you, because it's of the quality. The same thing with financial advice. Like they'll come to me versus like a Charles Schwab or something where they could get it for free because of the quality of advice, if that makes sense.
It does. Robo, I'm going to turn it over to you to ask the first line of questioning and kind of you guide us down the path. And then I know Jason's got his financial hat on over there with his 3D delt, so he'll be good.
Yeah, so I want to take a hypothetical person, someone who's just starting to make money. They're finally getting past the paycheck to paycheck phase of building. In this case, let's just say a trainer. Maybe they're starting to make 70, 80, 90K, having some extra money build up in their checking account. What would you recommend that they think about as far as emergency fund? When do they start thinking about investing? How do they take those initial steps towards building wealth?
Yeah. So the first thing is definitely an emergency fund. So, kind of like you mentioned, if you don't have an emergency fund, you're constantly going to be just running on a treadmill because, shit breaks, whether it's you own your house, rent your house, own a car, whatever, like things break in your life, expenses come up that are going to be unanticipated. So you need to have something ready for that. Otherwise, you're just going to keep getting credit card debt, keep getting some of these things that become sort of a hamster wheel that you can't get out of, right? Typically for like a emergency fund, I usually like to see people have, like, if you're single, if you can do 6 months of expenses, that's ideal. If you're, married and a couple that has 2 sources of income, 2 to 3 months might be much more reasonable, just because if you lose one job, well, you still have one job helping fund the expenses in your life, right? But if you are a sole income by yourself, you lose your job, you're screwed. So the more room you can give yourself as a single individual, the better, right? Really, the second thing you got to look at before you start investing is sort of what you're starting from. And I mean, these days, a lot of people start personal training businesses or get out of college and are just riddled with student loan debt, credit card debt, all these different things. So it's then really seeing like, okay, are you investing in things like, stocks, bonds, mutual funds, more what you would classify as traditional investments, or are you going the route of investing in paying off debt? And really the thing you need to look at there is the interest rate, right? So, from a typical, like say, stock portfolio, your return each year might be 8%. If you have debt that is, say, more than 5%, the chances of it being a better return on investment, just paying down debt, is pretty high. Just because you can go through 5-10 years without getting any money in the stock market. Whereas like if you come out and you have, 10% interest on your student loans, well, if you have $1 to either invest in the stocks or pay down your student loans, well, if you think of it this way, like, all right, if I pay or buy a stock with that $1, I may get an 8% return, right? Not guaranteed. Whereas if I pay off my student loans that are 10%, I get a guaranteed 10% return. So we really have to look at that, what that interest rate versus what your investment options may be to see like, okay, what is the best return on my dollars for an investment?
Are college student loans up at 10%, or was that just an example? Because I know mine was like 2.3 or something.
Yeah, I've seen them even as high as like 15% on private loans lately. Yeah.
So see, I to this day, I still haven't paid off. I still pay monthly because I can do way better on my dollar than 2.3%. I put it in stock anywhere and I'm making more. So I just pay the low monthly payment, and everyone's like, why aren't you paying that off? And I'm like, because it's 2.3%. So that's crazy number to me to hear. Man, that's wild.
Yeah. And that's like, so the things I've seen that are typically well over that are like, auto loans, some student loans, some like the government student loans, I think are right at 5% right now. Okay. So those ones are still pretty reasonable. It's mainly the private ones that have gotten ridiculous. And then credit cards, obviously, like I've actually seen, this was kind of a crazy experience for us, but since we haven't had inflation since, the 80s, our financial planning software actually didn't go high enough to account for credit card interest rates right now. That like, so they capped out at 25% interest rates. And now we've started seeing credit cards at 35% interest rates, which is absolutely insane. So those are the ones that are like, if you have anything like that, that's like super high interest, tackle that first. Otherwise your investing is pointless. But I mean, kind of your point though, Jason, is like, you have to look at it relative though. It's not just like a hard and fast 5%, because like, in Jason's world, like if I was going to go buy a business, which I actually bought 2 tax practices this past fall, my interest rate on those is probably, I think, 9% on my SBA loans, but I'm going to get much higher than that in terms of return on investment for those businesses I bought. So it's well worth it kind of, looking anecdotally at, hey, what's my return on investment with paying off the loan versus what I can make by having this debt. So it's really important to kind of understand, like, is this good debt relative to where I can earn elsewhere, or and just pay the minimums like you are with your student loans, or should I just pay that off and get it off my plate so I can then start building later in the future?
Yep.
Jason, Scoob, got a question you want to ask? Because I have a follow-up I'd like to know, and then I got to grab this thing at the door real quick.
Why don't you take your follow-up? I don't have anything where we're building this up. As we get into more maybe aggressive or more high dollars, I'll have some questions.
So you had said something about, Jason, the reason you don't pay this off is because you can make more money for yourself. Alex Hormozy is spreading a similar message of like, why would you invest in the stock market? You're getting 8% returns, build a business, you can make yourself 100% returns and all that. But my argument back is not everybody's cut out for entrepreneurship. So you're basically selling them a fucking wet paper bag dream. You know what I mean? Like, it don't work like that. I know it takes a certain mentality to keep going when you're getting your nuts kicked up in your throat. What is your counter to that? Especially with someone like me. I've been at that point, just like Jay was. You're like 80K and you're like, do I really invest in the market, or do I take this money that I have, this extra $500-600 a month, and start putting in ads to keep growing my business? At what point do you say, like, hey, you got to do these things or you're not going to have a future because you're wasting it in the time? That'd be my question to you.
Me or Jason?
No, you. I know Robo's going to give me some smart ass answer. You will give me the polite answer. I know that much.
Yeah, no, I mean, so there's a couple of different factors. I mean, yeah, to your point, like this is what I tell my clients all the time, that because like we're big advocates of buying businesses and things that to get that higher return or to get that cash flow, because it's one of the ways to break away from corporate America and not have a 9 to 5. But yeah, and the responses we typically get from people is, oh, I don't want to second job, or I don't want to work that hard, or things like that, and I can't afford to take that risk. Which all those things are reasonable, but when it comes to, let's say you do make that jump and run your business. I mean, really, when you kind of look at what the difference between reinvesting in your own business versus reinvesting in the stock market, again, it really boils down to what you think your ROI is going to be. So stocks have been pretty consistent through history at about, 9 to 10% on the high end, right? Within your business, I mean, like I've had years where I've gone 400 or 500% easily, like you're just not going to rival those numbers in the stock market. However, sometimes to scale your business, you have to do both. And that's something to kind of keep in the back of your mind for any entrepreneur out there, is like, even if you want to necessarily go all in on one thing, a lot of times, like, for example, like SBA loans for buying business, and Jason, you probably talk more about this than I can, or Robo. The banks are going to want to see assets on your books before they are going to provide you the money to leverage yourself up in a business, right? So you may have to have stocks to look pretty on paper to then, 10x your net worth with the business you own on the side, right? And so there's a lot of different factors that go into kind of how you make that decision to keep investing in your business or go into the stock market. But 9 times out of 10, it's going to be, as long as you have a minimum threshold for where you can pay back loans if you're going like SBA route or, debt financing route, really it just boils down to like, can I make more money via ads or via reinvesting my business? 9 times out of 10, the answer is going to be yes. Especially if you have good metrics around your, return on ad spend. It's pretty clear. Like, hey, I put $500 in, I came back with 2,500. Well, that's a no-brainer. Keep doubling up.
I have a question. Okay, so someone has taken care of their debt, and to the point they come to you. I don't know, maybe they're making 100K. They're feeling pretty decent about where they're at, and they have 15 grand to invest.
Mm-hmm.
How do you go about diversification? I mean, is the first level, should it be IRAs? Should it be stock? Should it be mutual fund? Or do you sprinkle it in everywhere? And I think that type of advice will really help our people who are past the debt issue, because I mean, if you've got debt and you're having high interest rates, got to get rid of that first. So we're beyond that now. Where does that first person start who maybe doesn't have anything, but they have a little cash now and they're feeling good about themselves and they have a little bit of extra?
Yep, great question. So the first kind of tier to that, and you mentioned IRAs versus like stocks. So there's a kind of a pretty clear delineation here where you first have to decide, like, what is the goal that you're trying to invest for? Is it, retirement long-term, or is it something more short-term, like a down payment on a house or starting a business?
Yeah.
Because that is going to have an impact on what makes more sense, right?
100%.
So in the world of investing, there's multiple different like account types you can invest in. There's retirement accounts, and then there's the brokerage accounts. We'll just kind of limit it to those two for now. But so retirement accounts, which are like the name suggests, are geared towards retirement and come with a lot of tax benefits to help you save for retirement, because I think the government understands that Social Security is probably not going to be around very long, and this is their answer to that. But with that, anytime there's tax incentives, there's also strings attached, and the downside is you can't touch that money till you're in your 60s.
Is it 65 and a half or?
It's technically 59 and a half.
59 and a half.
Yeah, I just usually round to 60, just make it easier. But so you basically until you're 59 and a half, you can't touch that money. So for someone like that's trying to save for down payment on a house, really not going to be that helpful unless they got a long time before they buy it, right?
Yep.
Or already in their late 50s. So a brokerage account is going to be something that's money you can access today, but is also taxable today, is something that's going to be more beneficial to them. So within those two types of accounts, though, you can really buy whatever you want. And in terms of diversification, the easiest way to diversify is with what are called either exchange traded funds or more commonly known as ETFs, or mutual funds. Because you can buy basically a basket of different goods, basket of different stocks, all in one investment. So there's a very low threshold or low barrier to entry, because you can go buy an ETF for $100. So if you have 15,000, you're not really limited. You can go buy a bunch of the same mutual fund, diversify within there, and it's an easy way to get started without a big nest egg. And these days, there's even a lot of like robo advisors and things that'll take it to the next level, where, like, for example, we have accounts starting at like $5,000 where you can basically do that, and then we'll go buy 10 different ETFs for you. Some will be like stocks, bonds, international, gold, commodities, etc.
So ETFs, those are a combination of a bunch of different mutual funds put together. Is that what you're buying into?
Kind of. It's basically, so mutual funds and ETFs are very similar to each other in terms of function. They're just different from a tax code perspective. So basically what they both do is they, kind of think of them like a bucket. So basically, within that bucket container, you can have any type of investment you want.
Right.
But so you can have like a bucket full of stocks, you can have a bucket full of bonds, you can have a bucket full of 50% stocks, 50% bonds, commodities, whatever. So then what happens is, if you put your money in, you're basically just buying the bucket as opposed to buying any of those individual stocks. So like, for example, within this, it could have, common ones like the S&P 500, either mutual fund or ETF. You can basically buy 500 stocks of the biggest stocks in the US all at the same time. You're just buying, very, 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 very small chunks of it. But then, you sell the mutual fund or sell the ETF, same thing, you just get your money back. You're basically selling all 500 stocks at the same time. The difference is basically mutual funds basically trade once a day. So your money goes in. At the end of the day, they see, okay, $1,000 came in. We buy $1,000 worth of stocks within our bucket, right? ETFs basically trade more like a stock does. So anytime between trading hours, 9 to 4, you can buy an ETF like that. So that's the biggest difference. And so because of that, without getting too much in the weeds, ETFs are a little bit more tax efficient. So you're not going to get as many tax distributions and things. So they're sort of the preferred route for that reason.
Okay. I actually have a question. Go ahead, Jay. I didn't know that, so
we the goal is very important. If I take it, if someone is there a limit on what you can put in an IRA for our listeners, based on income or based on the government?
Yes, there is. So each IRA is capped at, for this year, I think it's $7,000 a year that you can contribute. So it goes up each year, but you can basically, you are limited for just a regular individual IRA on how much you can contribute. That being said, I know we were talking about our sort of individual person being a, personal trainer, starting a personal training business. If you have like a business, you can actually set up your own 401k. And
I was going to ask about that. And is that 18,000 or is that based on income? I know I always put 18. I think
it's so it used to be 18. It's actually up to 22,500 now.
Is it now? Okay.
Yeah. Yep. So it's gone up a bunch, just with like the.
And anyone can do that, or is it based on income?
So anyone can do the 22,500. Okay. Well, as long as you made at least 22,500. So you can only contribute money into a retirement account that has been earned, like so earned income. But anyone can do that 22,500 part. If you have your own business, you can also contribute, as the business, which has a different calculation. But yeah, as a business owner, there's a bunch of different accounts you can do, such as like a SEP IRA, of individual 401k. I think there's a wide variety, but sure. you can end up contributing, like, I think it's the max is up to 63,000 total into retirement accounts now, depending on how you structure it. But
Okay.
So I actually want to kick this to Robo for a second. Josh brought up SBA loans. Is that even applicable for this conversation? Is there anything that like a person might want to know? Like, because a lot of people who listen to this podcast are, of the fitness background, but we do have a lot of entrepreneurs. Like, like we had Mahaley on, who's like the guy's handed 14 different things. When does an SBA loan, when is it advantageous, and when should one stay away from it? I guess you had someone as that.
If you're looking to acquire a business, SBA loans are the most accessible form of financing unless you have a rich uncle. So they're definitely beneficial.
Uncle Jay.
That being said, they can be brutal to get. The reason I say that is you can go out and get $200,000 in student loans at the age of, 18, 19, 20, 21. Just sign a little paperwork. If you tried to do the same thing on a business, not a chance. I mean, banks are so stringent. The SBA is so intense about the requirements. But it is possible as a way to really buy a business if you can come up with 10 to 20% down. Interest rates are also extremely high right now. So it's about stress testing around 11%. Josh mentioned he acquired for 9. It's only gone up since then. We're seeing close to 10% interest, and that's tough for a business that you're buying, especially if it's blue collar, you're learning it, you're trying to grow it. Because a lot of the businesses aren't, tech, these things that can be crazy scaled. A lot of them, you're just building client by client slowly. So you got to be real careful. In most cases I run into, smaller SBA loans don't make sense. You'd be better off to start the business on your own. We're talking, under 100, 200K. Most cases, just start the business on your own. You're going to do better. Above that, yeah, it makes sense. You can use the cash flow to pay it off. You'll be in good shape. But it's not going to be the easiest thing to get. But yeah, I'm going to jump for a second to something I think, Jeff, you asked Josh, and that's asking about, how do you decide between investing in the business or investing in retirement accounts? And Josh talked about ROI. It kind of goes back to that conversation we had at the beginning. If you're trying to make those decisions and you don't know the numbers of your business, you have zero shot about making the right decision. The reason being is no matter what you decide, it's wrong. Your decision should be to figure out your finances before you do anything. That's what, I've seen in the past. You get someone with 20K in credit card debt who has a business and they're like, should I open a retirement account? How much did you make last year? I don't know. Okay, well, you're not going to ever be successful, ever, hands down, if you can't figure out your finances. So
yeah, I always tell people, and granted, I'm biased here running an accounting practice, but the first hire you should have in your business is an accountant. Yep. Period.
I agree. That was one of my first ones.
Yep.
Yeah.
And if you don't know your numbers, you can't grow your business. Yeah.
Yep.
So is there any certain software that one might want to purchase to be able to help start tracking this stuff? I know we have QuickBooks. I think there's Wave, a whole bunch of different ones. From an accounting perspective that benefits a tax perspective, that benefits later on investing perspective, what software would you guys recommend people begin with?
I mean, the gold standard is pretty much QuickBooks. I mean, a lot of the other ones, try to make accounting more accessible. I mean, the problem is like every other accounting software, like it still bumps into the same user error issues. It just does it with a prettier UI. So it's really, QuickBooks is probably the easiest thing to use and get started, but it's also most accountants out there are going to use QuickBooks. So as soon as you're ready to plug in an accountant, it's good to already just be in there, because then you can just, they literally has a feature that says, add my accountant, and then they can see everything and 99% of the time fix your books.
Yeah, no, that was first person I made.
Yeah, jumping off of that, now that we're on the business side, someone who's making good money, starting to grow, at what point should they start considering different structures for their business, like an LLC or incorporating it versus continuing on as an individual?
Personally, I mean, especially in something like, sticking along the personal training line, I would say personally right away. Reason for that is there's really no tax benefits or anything for a lot of things like an LLC, for example. That's going to be your kind of easiest starting point. An LLC is basically stands for limited liability company. you can set one up on most states' websites in about 5 minutes and pay a $30 fee, and then you're good to go. It complicates your taxes a little bit, but that being said, from the IRS perspective, it's viewed as like a disregarded entity. So all the tax benefits you'd get as an individual, you're going to get as an LLC. The biggest difference you get with an LLC starting out is liability protection, especially when you're dealing with people's livelihood, their health, anything like that. Let's say you have somebody under a bench and it slips and, cracks their sternum and they can't work, that's a straight lawsuit, and, they're going to come after what little money you've started with. Right. So LLC, basically what it does is protects the business and versus the personal. So that way, anything that happens out of the business, they can't access any of your personal, dollars or assets or anything like that. So I think it's important to have right away if you're starting a business, especially if you're dealing with the general public. Other entities like S Corps and C Corps and more complicated entities, once you're starting to make some real money, call it 40 or 50 grand, switching to something like an S Corp may make a lot of sense.
Couldn't you just leave it in LLC and elect S Corp taxation? That's what I do.
Yeah, exactly.
And I just pay myself a salary, and then everything distribution, I avoid the 15% self-employment tax. And that's basically the way to go with that.
Yep, exactly. That's pretty standard way of going about it.
Yeah. Is there any point in time that you have to wait to elect S Corp taxation, or can you do that your first year?
You can do it right away if you wanted to. I mean, the downside is it just adds extra friction for starting a business because you do have to run payroll. You have to add some extra.
For sure.
Yep, a separate tax return that's not on your personal tax return. So it creates a little extra friction. So I usually just tell people, start with the LLC, make it easy, get used to having a separate business account, having keeping a separation of church and state until you're making money, and then once it makes tax sense, add on the S Corp because you'll have some of the the basics already taken care of. That's usually how I recommend going about it, but it can't hurt starting from day one.
This is the lawyer side of me talking now. Those of you out there starting LLCs, when you talk about separation church and state, you can't commingle your funds, guys, or you're going to lose that liability. If you do have something where you kill someone and then they start looking at it and you're paying all your bills and your fucking car and shit out of your LLC, they're going to say, nope, that didn't exist. The money has to come in. You got to then pay yourself out however you do so. You got to keep things separate. You can't just be paying bills straight out of that and out of here and out of there. It'll void your protection. Any sharp lawyer will get you. So
that was the sorry, go ahead.
No, I was gonna say I moved to a different bank to avoid that because the accounts were commingled. I said fuck this, and I moved to a whole nother bank, so I didn't have to worry about that. That's a good point Jay brought up.
Jeff, I could have gotten hurt anytime and sued you.
Jason, you walk around.
I had no
hurt.
idea.
He walks around hurt. Don't let him fool you.
Yeah.
Go ahead, Josh.
I was just gonna say, I mean, piercing, like any good attorney is the first thing you do when you get sued is gonna try to pierce the corporate veil, and the first thing they're gonna do is look at your bank accounts and look for statements that commingle or like anything like that. So yeah, your business is your business, your personal is your personal. Keep them separate.
Yep.
I think we've done a good job on the base level. I want to kick it up a notch. I want to go maybe to those who are making over $200,000 a year. You're starting to get a lot of extra money. What do you think about money markets? What about Bitcoin? I mean, we can't forget about that damn thing. Where would you start going at that point? Assuming the individual is financially conservative, tends to live on like I live on a low salary, so that way I can keep my investments and keep money to be able to do strategies I want to do with my companies. But what's the point where you say like, all right, you're making this kind of like fuck you money, and now you got to put it in a spot that actually benefits you?
Yeah, I mean, really the biggest difference is the sort of diversification of where your savings is going kicks up a level. So like there's been a bunch of studies that have shown really like, anyone that has sort of a less than $1 million net worth tends to on average have, 100% of their savings or outside of like their personal residence has like their savings in stocks, mutual funds, and kind of public markets. Once you get over that $1 million threshold, the alternative investments really kick up in the portfolio. So things like rental properties, business ownership, farmland ownership, Bitcoin ownership, those things you start to see a much bigger portion of the the pie. Reason for that is those type of investments you can't get out of generally in a liquidity need. So you don't want them to be in a big chunk of your portfolio, but you do, like, as your net worth goes up, you really want to add those things in because they add a huge component to your overall investments. Like, I mean, for example, farmland is, for the average investor is pretty inaccessible, but yet it's had essentially 30 years without a single down year and has outperformed any of the stock markets. So it's a phenomenal investment, and it keeps up with inflation, all these different things, but it's pretty, I mean, you can't just go.
What do you mean by farmland? Do you mean land that is vacant and then you eventually sell it, or?
So yeah, so what's pretty common in like the farm space is like basically similar to like a rental property where like you may go buy land and then lease it to a farmer, and so they're paying you farm rent. They may pay like a revenue share on the crops, so you can get some inflation hedge on the crops, and then land appreciates, and then eventually the land sells, and you can make money that way too.
Bill Gates is doing that all over the country.
Yeah, like the top 10 billionaires in our country are some of the biggest farm landowners
and it has to be zoned for farmland, right? Like you actually have to get the zoning for that, correct?
Yeah, and it's become a little bit more accessible recently. Like we have a partner that we work with, like called Acre Trader. Like that's like their whole business model is similar to like there's a couple other models like other for like Fundrise and real estate where you can basically buy a chunk of a rental property or a big commercial property. They do sort of the same thing where they may have a $5 million farmland where you can buy one share in that farmland as opposed to going out and finding your own $5 million farmland. So it's becoming much more accessible, but like that's really what you start to see, because like once you get over to $200,000 of income / start getting up to like the $1 million net worth, that's where you become what's called an accredited investor, and all these alternatives start opening up to you. And the more you can do these, the better. Like same like rental properties. I mean, there's a reason why most of the billionaires and stuff in our country have been made either off businesses or real estate, is because it's smart leverage. You can get 95% leverage on an SBA loan for a business, or you can get 80% leverage on a rental like a single family rental property. So those things just allow you access to investments that can outperform the stock market, plus give you leverage on something that you still have the asset. So in a bind, you can sell it, but it can also give you cash flow and stuff in excess of that leverage. So that's what you really start to see as you go up kind of in income and net worth, is really just addition of those type of investments. And like in Bitcoin's another one that's more accessible regardless of income. But I mean, I think it's a really good investment opportunity too, where, like for example, there's been a bunch of studies that have shown that even if you own, more traditional portfolio, even though Bitcoin on its face is extremely volatile, like it goes, up and down like crazy, right? But adding even like say 5% to a portfolio can have drastic impacts and actually make your portfolio as a whole less risky, just because it zigs and zags at different times than traditional stocks and bonds. And that's kind of the same idea of having farmland and some of these other things. And there is one, it prevents downside, but also adds a lot of upside potential too.
The only other question I have is, I guess when I'm at this point, because I'm there, I'm over that point, and I struggle with putting my money towards investments when I want to hold on to it for my business growth. So at what point do you say as a entrepreneur, your businesses should float your businesses and you should float yourself? Like, is there like a defining cut number you could give, or is that just individually reviewing everyone's like financials and going from there?
Yeah, it's very much a case by case basis. I mean, as a rule of thumb, kind of it goes back to, if you know your financials, like it's easy to see like, hey, is there an avenue I can put this money into my business to grow it? Or, like for example, like let's say like I think a big opportunity for me in the accounting space is buying up tax practices from baby boomers that are, like I think the average age of accountants is like 60. So I'm like,
oh, I can see that.
But it's like, to me, it's like I'm gonna hit a threshold where like, if I have 10% down for SBA loans or any other financing, I'm gonna hit a threshold where like, there's only so many businesses I can buy in a year and not go insane from an operation perspective. Right.
Right.
So there's only going to be so much I can invest, so much money I can invest in my business to max it out. So like, if you know what that threshold is, or have a good idea what that threshold is, then, let's say like if I have $1 million set aside, I mean, that's $10 million potentially worth of tax practices, which that's without even getting, fun with some of the negotiating and of the terms and things. So, I mean, could I bring on $10 million of tax practices in a year? Probably not this year. So if I had $1 million set aside, I might be like, yeah, realistically, maybe I only need 500,000, and then this other 500,000, maybe I'll go buy some farmland, or go buy, I have another buddy that I know is a entrepreneur over here that's starting a business that isn't in tax. So maybe I'll just go give him 500,000, be a silent partner in his business. And now I'm still getting the same access to business ownership, just somebody else is doing the work and I don't have to.
Angel investing. I love it.
Yeah. Yeah, exactly. So there's lots of ways to kind of make that determination, but eventually with every business, you're going to hit a, diminishing marginal returns where like, it's just not going to make more sense to solve problems with money. You have to solve problems with time, or just, usually just time. And then, there's going to be other places to sort of invest your money. So that's how I typically kind of come to that conclusion.
No, I appreciate that honest answer, because I know a lot of people I talk to in entrepreneur land. Jason and I have a few we talk to at the gym. They get like pinned with wanting to have all their resources to just keep growing. And at some point it's like, bro, you keep growing that business, it still could go away. And then you have nothing left for yourself, because you have to rebuild at some point. You're going to end up doing something else. I appreciate that answer. Robo and Scoob, do you guys have one you guys want to ask? If so, who wants to chime in first?
I was going to ask something. I agree, as your assets grow and your net worth grows, you obviously diversify. I've moved into real estate syndicates, and I've had a really, really good
Yeah, you have
returns. My best one is paying 14% on the dollar. And then most of them we sell 3 or 4 years, you get 2 times, 3 times your dollar. Plus I get all the depreciation dollar for dollar off my income. Are you a fan of those? Are you not? Are there some to watch out for that aren't good? Mine is ran by a close friend of mine I've known since 2nd grade. He sold out his businesses and made buku bucks and got in with the right people. So I've got a nice in. But are there any that you don't trust, or are there any that we need to look out for if people are at that level and they want to look at that? Because I really like the depreciation aspect. It really helps from a tax standpoint.
Well, so how does it help you though, for like a dumbass like
because they'll depreciate the building. Everything I own is commercial, and it depreciates throughout the year. You get your K1, you'll have a certain amount of depreciation on it, and that comes directly off my income. So if they depreciated $80K, and Josh can tell me if I'm speaking wrong, because I'm not a CPA, but if it's $80K depreciation, that'll come directly off my income number that's being reported.
Yeah, I mean, there's some nuances with it, but yeah, I mean, basically, for those that don't know what depreciation is, it's basically like, for example, in real estate, the assumption is that the house is going to break down and deteriorate over time, right? So what the IRS gives you to still incentivize you to buy into properties, they're going to give you a basic tax incentive that says, each year we're going to assume the house broke down or the building broke down by this much percentage. Yeah. So that depreciation is basically like a phantom loss that you can count against your income.
Passed off to us owners who own in the syndicate.
Yeah. So typically though, passive losses like depreciation have to be written off against passive gains. So one of the nice things about that though is you wouldn't be able to write it off against your business income, but you could write it off against the real estate income, which basically means you're getting income from that real estate syndicate essentially tax-free, or probably pretty close to it, right? So it's a really easy way to boost your income without necessarily boosting your tax bill. In terms of real estate syndicates, kind of circle back to your kind of original question. I mean, I'm a fan of them. I mean, my ideal is like, if you can, I prefer everybody to own them directly. You just get slightly more benefits.
Yes,
and everything if you own them directly.
Yeah.
That being said, a good property manager is hard to find. So if you don't want the time involvement of rental property, syndicates are kind of the next level of how to get access to good rental properties and kind of same returns without the workload. I can't think of, I was trying to think of specific names off the top of my head, but I would say good syndicates are the exception, not the rule. Most that I've seen are swindlers. So I'd say if you're going to go the syndicate route, going with somebody you know and trust is the way to go. Someone that has a really good record, but not too good, because if it's too good, it's probably for a reason. They think Bernie Madoff. But like finding somebody you trust that you know has the credentials, has the expertise. That's kind of the best way to go about syndicate. The other ones that I kind of like, I mean, they're not the best returning ones in the world, but I like that they're heavily backed in terms of like venture capital, like Fundrise is a big one. Not the best returns in the world, but because it is so visible, I think it's going to be pretty safe in terms of like risk. So like things like Fundrise, I forget the other one. I think it's like Equity Multiple is what it's called, or Crowdsource. Those are a couple I've seen that are more venture backed, kind of tech versions that just because they're so visible, I think are going to be a little bit safer. But otherwise, going with a syndicate you trust, is a really good option.
I would agree with that. I was even leery at first just to do it myself. And I saw a few deals and knew people that got in them and, put 100 in, got 200 back. So after a couple of years, but again, it was a close friend of mine. So I think that's good advice.
Yeah.
Robo, what's your next question before we have?
Very curious as far as meeting clients every day, talking to new folks. What are the same pitfalls that you see over and over that people make, or assumptions they make that just aren't so within the let's say personal financial side?
I could go on a soapbox forever on these. I'd say the one, I got two that really stick out. One is basically just, for lack of a better term, thinking you can invest yourself. Investing's pretty easy, but and I'd say most people have the capabilities and the intellect to invest themselves. But a lot of times, because the goals that they're saving for might be emotionally invested in, they then get emotionally invested in their investments, and that's when they make very poor decisions. Thinking like, hey, chasing down cryptocurrencies that you know nothing about, and just buying high, selling low. Same with just look at I sort of shit on Tesla stock all the time, but like, to me, there is no logical reason that a car startup should be worth more than every other car company in the world combined. And the only reason it is because basically people get emotionally, and they get emotionally invested in like, hey, I work for a tech company, so I have to be a Tesla supporter, so I have to own the stock and get in the hype, right? It's almost like my identity is tied to the stock for whatever reason. So that's a big pitfall, is just basically getting emotionally invested in what you're buying, where it's really should just be a sort of a math equation of like, is this a good investment? Yes or no? Check. That's kind of pitfall number one, is removing the emotion from any financial investment decisions. Two is your house, buying a house. This is something I basically have this conversation on a daily basis, where like everybody comes to me thinking like, hey, I'm buying this house that's way overpriced because it's an investment. And I always have to have the conversation of like, no, it's not. It's not an investment. It's an expense. It's a wonderful expense for like your lifestyle, and like you can build a lot of great memories with your house and all these different things. But in my entire career, I've seen only one person sell their home to fund their retirement. So it's really, as an investment, it just becomes basically a legacy for your kids, right? So outside of that, if it's not a rental property or where you're actually making cash flow and stuff from your property, then it's an investment. But if it's just, hey, I'm buying this house and I live there and I'm hoping the equity goes up, that you're kind of using it as a savings account, but realistically, once you add in the numbers of like how much home ownership just costs, really your money would be better suited elsewhere. So having that conversation of just like going into home purchase with a real understanding of like, I'm doing this because it's the right lifestyle choice for me and my family, et cetera, as opposed to, hey, this is the best investment choice I can make. Those are kind of the two biggest pitfalls I really see.
Interesting.
Jay,
Yeah.
you got Robo, do you have a final question? And Jay, I wanted to get to this before I ask like the last two, which kind of will be the last one, will be a debate, I think, among us four. So I'm just curious.
Okay.
Yeah, so I'll shoot one out and then let you guys go crazy.
Ooh.
If someone's trying to get educated and learn more, where would you point them to what
Good
resources?
question.
Like in terms of financial planning or investing or all the above?
Both. Let's just say trying to get more educated on financial well-being overall as an individual.
Yeah, I mean, it's honestly it's tough because like a lot of the sort of gurus out there all have really terrible advice. Like the sort of the best financial guru I've seen in terms of like financial planning and kind of especially like if you're just getting started is a guy named Ramit Sethi. So he had a book called "I'll Teach You to Be Rich" or "I Want to Be Want You to Be Rich" or something like that.
He has a TV show too, right?
Yeah, I think he has a TV show on Netflix now. I mean, I disagree with a lot of things he says, but in terms of just like pure basic finance 101 of like how to get out of credit card debt, how to do some of those things, he's probably the best of breed. I think he's definitely lax in terms of investment stuff. In terms of investments, depends on kind of what you want to get into. If you want to get into like buying individual stocks or anything like that, I mean, even going back to some of the classics like Benjamin Graham are going to be they're dense books to get through, and it's like reading a textbook, but it's probably the best source of. I mean, that's the book that Warren Buffett learned how to invest on. So it's probably the best of breed when it comes to like just understanding how stock and bonds work and how to think about investing. Outside of that, like there's a tons and tons of resources. Those are kind of the best in terms of starting ground.
Yeah, I'm going to echo what Josh said a little bit ago as far as scammers as well. Your financial advisors, maybe over half, are only interested in what they can get out of your pocket and put into theirs, not really your goals. Josh, maybe that's an unfair percentage, but if they try and sell you load funds, a lot of these firms where you're paying crazy fees, man, they don't give a crap about you. So the more you get educated, the more you can spot that stuff.
Yeah, exactly. And pretty much like if you're going to any of the big firms, they're going to try to screw you. Like the Fidelity, Schwab's, TDs, Edward Jones, like they're all incentivized for basically to make money off you as opposed to like educate you and sort of do right by you. So yeah, the more educated you are, the better. I mean, some of the gurus I'd say stay away from would be like, I think
Grant Cardone.
Yeah, Grant. He had some good things, but like the Dave Ramsey, I think gives a lot of terrible advice, especially with investments.
He's down here, man.
Yeah. You
He's going to show up at our place.
Yeah,
it's only a few miles away.
My gym and like shoot me or something. Fucker. Now I'm dead. All right.
Yeah, someone like Susie Orman, like all these like the big ones. Most of their stuff is garbage. So there's a lot of like honestly, actually even a good way to go about it would be there's a lot of like small independent companies all over the country at this point, like similar to like my firm, where even just starting to read blogs and stuff by those individuals, you'll probably learn a lot. Or you're even just setting up time, whether you want to hire a financial advisor or ready to or not yet, setting up time to meet with them and learn a little bit might be worth your time and theirs.
That's a good question and good answer. Scoop, what have you got to round this baby out? As my voice sounds pre-puberty from Kraken.
I guess, I would be curious, I guess, from a selfish standpoint. Someone has stocks, they have crypto, they have real estate, They've done well in properties. They've bought housing, all those things. What are some other vehicles to look to invest where maybe they have, I'd say, a pretty aggressive tolerance? So I don't think annuities would be anything that I'd be interested in. But what about, some other things that we haven't talked about? Are there any other vehicles out there you'd be like, hey, maybe you should look into that?
Yeah. So, I mean, actually, it's kind of counterintuitive, but especially if you're like aggressive, some of the best investments to have in your portfolio are the ones that are like the anti-aggressive, because the biggest problem you see, and this is what affects like a lot of the emotional investors is basically it's more important in terms of investing to actually protect against losses than it is to get gains. Losses can be more detrimental to your portfolio long term than having a higher rate of return when the math works out. So like there's things like that are called like managed futures or long volatility. Those are kind of designed to do really well when shit hits the fan. So they act as a really good counterbalance on someone that's like doing crypto investing or entrepreneurship, where it just ebbs and flows. Because the times where your other stuff's impacted, it's like killing it. Like managed futures, like last year when shit was hitting the fan, it was the highest performing asset class out there.
Interesting. Okay.
So things like that do really well to sort of balance out the returns over time and keep them higher on average.
Can that be held in a brokerage account, or is that something different? It can.
Yep.
Okay.
Can be like a mutual fund or ETF.
Okay.
It's usually the structure they'll come in. I mean, they can own it like what's called like a separately managed account, where you just basically dedicate an entire brokerage account to that function. But it's most common in just like a mutual fund or ETF.
Okay.
Yeah, so those are good. Yeah, I'm a big advocate of Bitcoin as like another hedge.
How do you feel about Ethereum?
Less bullish, but still bullish. So I mean, my sort of view on it is like I think crypto does have a future in this world, right? I think that's pretty well established. The reason I like Bitcoin is because it's the only truly decentralized crypto that's out there. However, Ethereum, my sort of view on it is like, I'm not a venture capitalist. I'm never going to be able to sit and figure out which crypto is going to make it, right?
Yeah.
So I kind of take the, gold rush approach of, all right, instead of trying to find the gold, I'm going to buy the pickaxes and shovels. And I think that's what Ethereum is in the crypto world. It's what, the other crypto is getting built on. And so
that's why I bought it. I have 25 of them. I don't plan on going in deeper, but I just going to hold it. I'm just hoping that maybe one day it kind of gets a little Bitcoin fever and then maybe I'll dump it, but that's one I went for, because for me, Bitcoin already had its run. And so I was like, I don't know what I'm going to get out of that. So I went for Ethereum. So we'll see how it plays out.
Yeah. I mean, I think both have their merits, and that's so which one ends up being the top one, who knows?
Right.
But I think like I'm a big believer in kind of like the future of esports and stuff, especially with like the way like tech and stuff is going. And I think esports within the crypto space are fascinating. I think that, and most of them are being built on like Ethereum and Solana right now. And so
Ethereum's big. My 12-year-old and my 17-year-old were gambling Madden games and Call of Duty games with Ethereum.
Yep.
Like I think that's where I see a lot of the future and kind of the Ethereum space. Same with like NFTs once they adapt it to more sort of useful uses. Like I like the art is cool, but sort of that kind of call it decentralized contract, if you will. Once that gets into things like, hey, I can buy a chunk of a Beatles album or like a Beatles song or whatever. Like again, a lot of that stuff's built and sort of done on Ethereum. I think that's where you're going to start seeing some really cool stuff. And I think that's going to lock in Ethereum's value too.
It's interesting you mentioned Solana. I almost bought some of that, and I thought, what, I'm just Ethereum. From what I've researched, it seems better. So I guess I didn't do too bad in picking that up. It's a buy and hold. So we'll see.
Yeah, it seems like the Solana's biggest play was just that it was cheaper and in terms of like gas fees. But the what was the like first mover advantage was already there for Ethereum. So yeah, I think it's pretty locked in.
Final question before the final question for us to chat about. What is the advice to escape the matrix, aka retiring early? I don't know
Really,
why
it's
the
like-
fuck people want to do it. I can never see myself doing it. But people are obsessed with retiring at like 42 and shit. So figure out to ask.
Yeah, I had that question almost on a daily basis. Like our sort of mantra at Vincere is like, hey, you know, we're not going to get Social Security any of this shit at 65. So it's like, why worry about a retirement later on? And you know, let's get you to work optional as quickly as possible. Like if you don't want to work, you don't have to. But if you want to give your boss the middle finger, like you have the money to do so. But like, yeah, the way I kind of always explain this is like, there's two ways to fund retirement. You either build up the assets to, you know, make them last long enough for you to, you know, not see them dwindle and while you're still alive, or you find income sources that replace your work income, and theoretically income sources that don't require you to work your same corporate job or work as hard. And so really the two best sources for replacing your income are real estate and business ownership. And real estate, kind of we talked about, there's ways to get that income from real estate without the workload, whether it's hiring a good property manager or syndicates, owning a business. I mean, these days there's a lot, I guess Jason, I'm sure Robo will attest, there's lots of businesses out there that can be run for a lot less effort and decent cash flow. So where you may be working 5 hours a week to just keep the wheels on the bus, as opposed to like, if you have no intention to grow it or don't care about growing it, you just want your salary. Or you can invest in someone that, you know, does want to grow a business and just give them the liquidity to do so. You can be the rich uncle. But those are kind of the two main ways. You know, there's like all sorts of things out there nowadays, though, like building ebooks or building online courses, or you name it, of like ways of doing passive income. But, you know, to me, it's really just the easiest entry, or buying a business, or being an investor in a business, or investing in real estate. That's pretty much it.
I like those answers because those are probably the most honest ones about how to really do it. The ones that people don't want to hear. Last question. I'm going to open this up to you guys, all of us. Interest rates. Why is it a shit show? Why they keep throwing those fuckers up through the ceiling and nothing's happening? And as far as I can tell, it's just hitting a lot of really the housing market, which it really hasn't cooled off from some of the people I've talked to, depending upon where you live. But what do you think about that? What do you think that the route that they're going? Like, I guess what I'm getting, we talked a lot of financials here today. We talked about all sorts of stuff. At what point do you think the interest rates are worth getting back into on those vehicles? Like you talked about buying a house, Robo talked about buying a company. I could imagine doing a loan on a company at a 10% note, like on $1 million loan or something like that. So I'm just trying to wrap my head around why you all think, more of the financial people, the interest rates are the shit show and it's not doing what it's supposed to be doing. And when will we get relief?
Do you want the weeds answer?
I want it all. I think the better the answer, the we can all walk away, because it doesn't make any fucking sense from a normie like me on it. I'm like, well, it's not working. I don't know what you guys are doing, but it's not working.
Yes, I mean, realistically, what's happened is basically during COVID, lots of money was printed, right? And so the equation for inflation is basically money time, the amount of money times what's called velocity. So, AKA how much times money is changing hands. Well, you may have, like, if you kind of look back to like what happened during COVID, everyone's like, oh, inflation is not going to happen, or it's going to be transitory, because even though the money supply, shot up $9 trillion, which was like unheard of before that, the velocity was really low. So all the economists were basically saying, oh yeah, inflation is never going to happen because velocity is really low. But what no one kind of factored in was the fact that we were all sitting at home, not spending money. So as soon as the world opened up again, velocity kicked up. And that's when we started seeing all this inflation, rise. Well, what's happened also is, if you understand politicians, they don't want to make it look like there's a lot of inflation in the world. So since the last time we had inflation, they've actually changed the way they measure inflation. So back in the 1980s, it was very much like, okay, yeah, it was in the 80s. It was like, okay, this widget in 1980 was this price. The same widget in 1985 was, 10% higher, right? That's the inflation. Nowadays, what they have added is they assume that the average individual is substituting other things as prices rise. So let's say, for example, you eat at Whole Foods, you always eat at Whole Foods. It's important to have, grass-fed beef from like top sources without antibiotics and shit like that, right? Well, what the Fed basically assumes now is that, the moment inflation kicks up on your beef, you're then switching it to, Aldi about to expired beef, like, which is, obviously much cheaper, right? So like the CPI that you hear in the news is actually significantly lower on paper than what it would have been if you calculate it the same way back in the 1980s. So when they were saying CPI was at, say, 9%, in reality, it was actually closer to like 16, 17%. And you saw that in bread prices, egg prices, things like that. Well, the other thing on here is that the only way to fight inflation really the only tool that's historically worked is raising interest rates, which basically tightens that money supply. So the amount of money basically takes it out of the system, because, like you were saying, as interest rates go up, people stop borrowing money. Well, what then happened is throughout last time every time we've had inflation, the only way inflation has really stopped is if interest rates have gone higher than the rate of inflation, which right now they haven't. And the other part of this too is for inflation to really stop in its tracks, things have to break. And you sort of saw that with SVB collapsing and some of the bank collapses we already had as the start of things breaking, right?
Right.
But the Fed's kind of play lately has been, oh, we can't let the economy break. Everything has to be a soft landing. So right now they're just letting rates stay high, like stay where they're at, and just trying to see how they can sort of finagle a soft landing. And they don't know at this point. Like, this is all experimental. So that's the problem. They're going to have to, they either have to just keep raising it sharply to basically break the economy and start over, or they're going to be playing this game for however long it takes to see if they can sort of walk that, tightrope of bringing the economy back to a stable place without it breaking, which is, and while stopping inflation. So it's basically a tightrope they're walking, which I personally think they're going to end up having to just break the economy, but that's just me.
What about you, Robo? Economy gets broken?
Yeah, Josh's answer is the politically correct one, and I'm going to go the opposite way. The federal government doesn't give a shit about any of us. They don't. They give a shit about their wealthy friends. They give a shit about the wealthy companies that pay for them to stay in power and continue making the rules that they already make. Because of that, when they see many of the issues the Fed's taking, we think, all right, the Fed's trying to protect us. They're trying to slow this down. They're raising interest rates. They're going to stop this. Somehow they're going to do this magical soft landing. I don't believe it's possible. We learned that the Fed is no longer independent a couple of years ago when Jerome Powell sat there and said, inflation is transitory. He echoed exactly what the Biden administration had said and what Janet Yellen said. He knew better. And you saw it because as soon as he took action, he took drastic action and quick. He knew the damage was done and there's no easy way to get out of this. When we go down, we're going down hard and it's going to hurt. Bank failures, I mean, if you look at 08, 09, I think we had 300 billion worth. We've already passed 500 billion. There's major groups defaulting on loans on commercial properties, especially office properties in major cities. What's holding the economy up right now is fake. The Fed is sitting there saying we're raising rates, it's going to be okay, no big deal, while personal debt is quadrupling for the average person because they can't afford to live anywhere near what they used to. Yeah. There is no easy landing. There is no soft landing, in my opinion. We're all just going to be fucked for a while, and we better make our peace with it and have some money set aside.
Yep. What about you, Stu? And then Josh,
I know. Well, I mean, okay, so I'm trained at least undergrad as an economist. So, the normal thing you say is, well, inflation's up, and that's what Josh was talking about, and that's how the Feds control it. They rise interest rates. But what Robo's saying is also, striking a chord with me. I don't know the ins and outs as well as he does, but I think there's always a politician play to keep themselves in power. And, I don't trust the administration in there now. I mean, without getting too political, but I think that the last piece of thing I can say is I was having a conversation yesterday with Aria, and I said, man, things are just really sky high, gas, this, that. I'm like, I don't know how the average person is making ends meet. And, I said, it's really sad. I was like, I have no idea how they're doing it. I mean, I'm very blessed and fortunate, but I don't know how the average hardworking, person's doing it. So I don't know what the solution is, but I know what my schooling teaches me, but I also know what Robo's saying enough to know that I think, there's some other things at play there, but I'm not educated enough to go any deeper than that. So
if you want to make money, go into politics. You can counter it always if you know what's going to happen next. Look at Tommy Tuberville.
There's actually a fascinating book on this. Like that's I don't know if you've read this yet, Jason, but it's like Ray Dalio runs the biggest hedge fund in the country, actually probably the world. But he wrote Principles for a Changing World Order, where he basically went back through 1,500 years of history and met with like all the top historians, economists in the world, and basically painted this historical picture of what makes like nations rise and falls and currencies rise and fall. And basically what it showed is like exactly what we're going through right now, where like you go through this century of like just boom, where like it's nothing but good times. And then you get to this point where it's like, hey, we want to keep these good times rolling. We no longer can afford to do so. But we keep doing it, regardless of the costs, because, human nature, right? And if you kind of look at, like, to Jason's point, like, look at the politicians, like if the market goes down 60, 70, 80%, which is it's well poised to do, every politician's getting voted out, right? And so that's why they're so big on this idea of a soft landing, is because they're basically just trying to kick the can down the road until, most of them are like 95. So like, they only got a few more years left in politics. So they just want, the next generation of Congress to have to deal with it, and not them.
They only use lagging indicators. They always have through history. So even if you want to stop it, you're measuring things 3 months too late. Good luck. No one uses a leading indicator on the economy. It's insanity.
Yeah.
Dude,
because that would mean they'd have to make real decisions that impact them, and and could risk losing an election.
Well, and the question is, what's a leading indicator on inflation? Printing a shit ton of money. It's the simplest formula in the world.
Yeah.
I say I called inflation 1.5 years before it ever started. It was easy, and I'm not an economist.
Well, I have to say, this is probably one of the coolest conversations I've had, because it was very twisty and turny, but provided a lot of interesting information for people to start thinking ahead. And I will say this from a person who had to work 2 jobs the majority of my life, 6-7 days a week, that is the path to freedom I found for myself, and I'm quite sure it's for most people. So there's a work harder and smarter aspect, and I think you guys cover the work smarter aspect, and we shouldn't forget that you have to work hard to be able to get there. So Josh, where can everybody find you? Where can everybody throw you their money, their stripper dollars, whatever else they got? Jay's got to get ready to go to do karate with Maddox. So we want to make sure you have a chance to pimp your platform and tell everybody where you can help them.
Yeah. So Vincere, like Vincere wealth.com is my company. Same with VincereTax.com. Same deal. You can find me on either of those. And I'm going to host the social media platforms too, which I won't bore you with all of them, but Vincere is probably the best place to find me. If you ever have any questions or want to talk money, I'm a nerd when it comes to this stuff. So, always happy to talk shop.
Nah, this was a hell of an insightful, conversation. I know, like,
I appreciate that.
from talking to Robo in the past, sometimes I'm like eyes glazed over when I like talk to him about shit too. So it goes both ways. But this one I think was a very applicable one, which is what we wanted to provide our audience. So thank you again, man.
Yeah, my pleasure. Yeah, appreciate you invite me on.
You're welcome. All right, guys. Well, I'll catch you all later. Peace.
See you guys.